All right, so financial management. Lecture is number 10. We continue. You can open your textbook by Brigham on page 129. And the topic for today is financial institutions. Now, my list, I have a list here. Well, the textbook has got a list of 10 of these, but I kind of like added 2 more, so maybe we can expand the list up to 12. First big one is investment banks. And investment banks do a lot of things, but the way we said it a long time ago, simple, straightforward definition: financial institution which specializes on the primary markets. This means it specializes in the issuance of brand new securities, okay? So that's the definition. Now, you have a lot of things going on, and okay, I'll make here a side note. When you go on my YouTube channel, and my YouTube channel is K.M. Petrov. There is everything is organized in playlists, all right? You're the new internet generation. You should know about YouTube. So the playlist, I have right now featured 12 playlists. Number 1 is macroeconomics, which is introductory. Number 2 is managerial economics, which is microeconomics for managers. I got business cycles, fixed income securities, financial management. There's a course there, a whole course university called financial institutions. And it has about 12 lectures, 12 videos, basically doing 1 lecture per institution, okay? And it begins up front with the first 4 lectures on commercial banking. Yes, that's number 2 over here. So if you really want to go through the whole detail, it was recorded in 2009 spring, that's 2 years ago, in Saudi Arabia. It was teaching MBA students, and they had a special topics in finance, but the financial institutions material is mostly introductory in nature. And it's basically the same story. 1 full lecture, maybe 1 hour, maybe hour. They're like double lectures over there, so sometimes 65, 75 minutes on 1 particular institution. Here, we got to do it 10 times faster, maybe 1, maybe 2 lectures to cover all of them. So this is your YouTube reference for more learning for anyone who wants to learn at any point in time more. Now, getting back to investment banks, the first thing is called issuing securities. Let's put it as underwriting. Underwrite. And underwriting essentially means to assume the risk of issuing a security. To assume the risk of issuing a security. In other words, when a corporation wants to issue a security, the underwriter guarantees a price and a quantity, number of shares sold, and the underwriter effectively, technically and legally buys them out from the issuer and then resells them at a margin, meaning at a profit. And the risk is entirely borne 100% by the underwriter. So investment banks take the complete risk. Of course, they're not that kind of stupid. They're not going to be taking big risks anyway, not with their own money. So they'll assume the risk late in the evening. In other words, the underwriting process, the actual purchase will occur after stock markets close, sometimes as late as midnight. And then they're going to resell the shares and the stocks in the morning. They'll usually have what's called subscription, and subscription is investor willing to buy a certain number of shares at a certain price, and they ask you how many shares you want. You say, I want 1,000. The other guy says, oh, I want 100. You say, oh, I'm a big pension fund, I want 50,000. Then you say, oh, I want 1 million. I mean, good company. So they provide or compile a complete list of everybody who wants to buy at whatever prices. They judge what the price will be, and based on that judgment, they usually buy out from the issuer at a discount so they can make a juicy profit, right? They run on profits. So in the underwriting, they take the risk, but the risk is actually, in terms of time, very, very small. Usually the risk is less than a day. Sometimes, you know, but again, the whole issue of risk in issuing securities is extremely complicated. You need to take a special course in investment banking, but these are the basics. Well, what else do investment banks do? Well, the other thing that they do or love to do is trading. In trading, they buy and sell securities for their own accounts, risking their own capital. They buy mortgage-backed securities and later sell them. So they buy stocks, later on they can sell them. Currencies, gold, silver, oils, they do all sorts of trading. They may have, but it's extremely rare, they may have just investing. They might have some investments. That's rare, that's small business. Many don't even bother with this. What they will have is called money management. Money management. In money management, they actually run a mutual fund. They run it, okay? Kind of like the mutual fund will be theirs. They won't own it. It's called, they will sponsor it, okay? They'll be the managing firm, but they'll run that. They may run, possibly or very likely, money market mutual funds, okay? They may run other, possibly pension funds, okay? That's also a possibility. So when we say money management, this is exactly the same as portfolio management. It's exactly the same. Sometimes it is part, and sometimes they like to put it as a separate, so we're going to join these together. It's called wealth management. Wealth management is for rich individual investors. So, these two are exactly the same thing. The main difference is that money management is institutional. And wealth management, sometimes, the question? Yes, wealth TH, thank you. And wealth management is called individual. They like also to call it retail. Retail means for a particular person or customer. So individual is in retail. Many investment banks will run brokerages. So they will be themselves brokers. So they may be also, so underwriting, trading, okay, let me write it both one at a time. They may be dealers. Dealer and dealer as in market maker. Market maker. There's a difference. Let's explain the difference. Dealer is someone who buys an asset or sells it short for his own account. So he buys it, he holds it, he risks it while he's holding the position, whether the position is long or short. That's dealer. Market maker is someone who has both a buy and a sell for the same asset at a spread. So market maker at any point in time, if you want to buy, they're going to buy. If you want to sell, they're going to sell. Okay? With a dealer, they don't have to buy if they don't want to. And they don't have to sell. Market makers usually do the buy and do the sell. And of course, they do it for a spread. Okay? And they also do separately brokerage. Now, brokers and brokerages are typically or usually or commonly a very separate institution. It is a separate financial institution, but it can be happening as a function. In other words, they could be offering broker services. Sometimes, and let's introduce now a new term, sometimes these financial institutions that specialize mostly in these are known, and there's a whole category in textbooks. It's called broker-dealers. 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 Well, I should have made this investment banks in red, but that's okay. So a broker-dealer is a financial institution that provides either brokerages, in other words, it's trading for its customers, that's the broker, and dealer, it's trading for its own account, trading for itself, for its own profit and loss. Let me see, I mean, I can go basically for another hour on investment banking, but we can't afford it today. You just gotta go there on YouTube and get the full lecture. This is the short and sweet version of investment banking. Number 2, okay, let's do this now. Commercial banking. And therefore the financial institution becomes commercial banks. And as I've explained and repeated many times, commercial bank is a financial institution which accepts deposits and makes loans. Accepting deposits means that the institution is also known and called, or part of the group called, depository institutions. So we can say that commercial bank is a depository institution, but there are other depository institutions like savings banks, like savings and loans associations, well, credit's a little tricky, but so other depository institutions. Now, what else is a bank doing? Well, other thing which a bank might be doing very commonly is simply checks and check writing. Sometimes we just call it checking. Very, very, very common. Sometimes they'll specialize, well, sorry, not specialize, my mistake. They always do these two. They will provide as an extra service debit cards. Debit cards. Some banks, or many banks, will also provide as an additional service credit cards. Now, let's clarify important legal and later on becomes a financial and economic distinction. Let's change the definition of the loan of the commercial bank to the correct legal definition. It is financial institution which accepts deposits and makes commercial loans. Commercial loans. Commercial loan is a loan made to a business, usually for business or for profit purposes. So, you may have institution which accept deposits and makes only mortgage loans. Mortgage loans. And if it makes mortgage loans, then technically and legally is not a commercial bank, okay? Technically and legally is going to be a savings bank or a savings and loan association, okay? So, it is a commercial bank only if it makes commercial loans. But commercial banks like to make not only commercial loans, they like to make mortgage loans. They like to make mortgage loans because they are thinking very incorrectly and wrongly that mortgage loans are safer and more profitable, which of course is totally wrong. Mortgage loans are always a lot more riskier, but they live under the illusion. It's a culture within bankers which persists for many, 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 many decades that mortgages are somehow safe. Yet 95% out of commercial banks, 9 out of 10 or 19 out of 20 go bankrupt because the mortgage business drove the bank into bankruptcy, as just happened in the global financial crisis, in the Japanese crisis before that, you know, even in the Asian crisis you had a lot of mortgages going on. Usually mortgages sink a bank into bankruptcies. Banks love to do consumer loans. Consumer loans. And they love consumer loans because the spread on consumer loan is huge. The margin is huge. The cost of funds is maybe 4 or 5%, and they lend to consumers at 12 or 14 or 15%. So on huge margins, consumer loans are extremely profitable while the consumer keeps paying. When the consumer stops paying, the bank goes bankrupt, okay? Because consumers usually aren't very good at managing their own money. And consumers are usually very risky. That's the fundamental reason. Back in the old days, we're talking about 150 years ago, when people understood banking very well, They understood that mortgage lending was extremely risky. And they said, no way, you can't make mortgage loans. And you can't make consumer loans because they're extremely risky. And they limited commercial banking only to commercial loans, okay? And for a while, commercial banking ran well. Then, as commercial banks started doing mortgage business, consumer loans, and a whole bunch of other things, they started going regularly into bankruptcy, regularly into financial crisis. They caused the crisis through their own risky lending. Okay, let's write this up here. Is risky despite the common belief that it's actually safe, especially the mortgage lending. And back in the old days, things were doing so much better because banking was simpler, easier. When you lend to a businessman knows what he's doing. Businessmen aren't stupid, and they haven't survived for 10 or 15 years because of stupidity. Obviously, they know a little bit about money, in managing money and everything else. So, that's number 2 on commercial banks. Number 3, let's change this in red. 3, financial services corporation. Financial services, maybe the legal name, we just call them financial conglomerate. Conglomerate. And the conglomerate is a basic combination of very many different businesses. Conglomerates are common, have been always common in Japan. Conglomerates have been always common in Europe. In the United States, they have not been common. Conglomerates have been prohibited for many, many, many years, since 1930s and the Great Depression. The merger of commercial and investment banking was recognized to be leading and causing to disaster, including brokerages. And conglomerates were basically playing with depositors' money. So conglomerates were prohibited in the United States for almost 70 years. In 1999, they were allowed. The law that prohibited them was called Glass-Steagall Act, maybe 1932, maybe 1933, I don't remember the exact year, right after the Great Depression. And Glass-Steagall Act separated commercial banking, prohibiting commercial banking to involve in other messy areas, from especially investment banking. So investment banks can't do commercial banking can't do investment banking, and separated them from insurance. You do investment bank, you can't do insurance. You're a commercial bank, you can't do insurance. You're an insurance company, you can't do commercial banking, investment banking. So this was back in the old days. It was known as the Chinese wall between commercial banking and investment banking. Well, the Glass-Steagall Act got repealed in 1999, and at that point, commercial banks started playing with investment banking and insurance and all sorts of things. Investment banks started playing with commercial banking and everything else, and basically, banks started playing with other fields which they didn't understand very well and got themselves in trouble. The problem is that conglomerates require extraordinary degree of knowledge, experience, and ability of risk management, and most modern managers aren't capable of doing that, and the result is they just blow up. Kind of like Lehman Brothers, what happens recently. Well, Lehman Brothers was not a conglomerate, but now all the big conglomerates are in deep trouble. The problem is they're so huge, governments don't let them collapse, so government just habitually bail them out over and over. Throw 10 billion, throw 20 billion, throw 30 billion, throw 40 billion. It's easily for a conglomerate to suck in $100 billion now since the global financial crisis began. So this is basically a collection of all sorts of financial services, of all sorts of financial institutions, all under one big roof. Okay, very common in Asia, very common in Europe. For 70 years, strictly prohibited in the US, but now also available. All right, next one, credit union, number 4. Credit union, let's see, is associated with a particular group of people that have something in common. Maybe they're all retirees. That's an example of a common group. Maybe they're all firemen. Okay, maybe they're all policemen. Very common for credit union will be for teachers having their own credit union. Credit unions back in the old days were depository institutions. Now they're non-depository institutions. It basically means that credit union runs on equity only. Credit union runs on equity only means that there are no debts on the balance sheet. There is only shares. And the credit union, we call them members, are actually the owners of the credit union. Credit unions are believed to be safe, but they're not. You are a shareholder of the credit union. All teachers own it jointly. When there is a profit, they share the profit jointly. If there is a loss, they take the loss jointly. Back in the old days, they were run fairly conservatively, so usually they don't run a loss. Why wouldn't they run a loss? Well, because if there is a credit union of 200 teachers and they are all in the neighborhood in the 3 schools, they know each other very well. You're a teacher, you work with the other teacher for 7 years. Are we going to give him a mortgage? Well, all of you guys know him. Is he good to pay or not good to pay? If you all know he's not good to pay, you're not going to give him a loan. So, because everybody knows everybody else and everybody knows their honesty, integrity, skills, and ability to pay, because you watch him on the job, you know him on the job, you're going to give him if he is good, and you're not going to give him if he's no good, okay? So it turns out that the credit criteria in credit unions have proved to be the best in all of lending businesses. And the reason is that when you go to a commercial bank, a commercial banker will interview you for 30 minutes. Maybe he's going to talk to you for an hour. He's got to get your credit score, maybe good, maybe not good. He's got to get some documents about your taxes. In 1 hour, he's going to make a judgment. Now, is a banker good enough to make a good judgment for an hour, or a teacher good enough to make a judgment about his colleague and friend, which they've been working together for 15 years? And the experience is that one fireman is better at judging his friend fireman than the banker, whether his friend is good. Why? He knows his wife, he knows his children, he knows where they work, how much they work, if he's a hard worker, he's on and all the other thing. So credit unions have been fairly solid and fairly stable institutions. They are owned by the members and they lend only to the members. Only to the members. So they don't just lend to anybody. They run it, it's their own, they run it for their benefit, and the way they run it is, you need a car, okay, yeah, you're good person, we know you who you are, you're teaching good math or geography, we're going to lend you for 3 years for a car, we know your job, we know where to get the money, we know you're good for it, so no problem. So credit unions have been, so far, the most stable financial institution. The reason is that, number one, they're all equity, there is no leverage, and with no leverage comes no financial risk, and there is only credit risk associated with loans, but credit risk is monitored by everybody in there, and they lend only to people which they know, so they minimize the risk, the credit risk. Next one, pension funds, 5. All right, let's try and do this. Let's slide this little thing here and go with 5. And pension fund simply specializes in managing money for retirement or for retiree, okay? It is a financial institution. Pension funds by law are prohibited from borrowing and therefore are prohibited from any form of leverage. They are all equity, 100% equity, no debt. So pension funds usually have, let's write it out, no leverage. Second, pension funds are required by law to be investing only in low risk investments. Now let's clarify important development in financial banking and government propaganda. Back in the old days, for I don't know, maybe 100, 150 years, people understood very well that stocks are extremely risky. So pension funds were allowed to invest in bonds, only in bonds, also in gold, also in cash. Cash is fairly safe, gold's fairly safe, bonds, government bonds and corporate bonds, as in very low risk, good high quality corporations. Over time, of course, there have been many judgments by judges who are kind of like, of course a pension fund can invest in stocks. It's extremely risky. It is not a prudent investment. So the legal requirement is called that investing must be prudent, which in good old English means conservative. Conservative. Which is, back in the old days, they just call it safe. You can only make safe investments. In modern finance, prudent conservative is safe, we just call it low risk, okay? So, back in the old days it was prohibited. With propaganda and a whole bunch of other things, bankers, especially investment bankers, were able, because they are salesmen of stock, to change culture and mentality to make it common for pension funds to invest in stocks too. They say, well, some stocks aren't that risky actually. Of course they are, that's a different story. And then they use the argument, well, for a little bit of diversification it won't hurt anyway. And then, well, if you're diversified, you might as well diversify also a little bit into commodities and into currencies. And then we now know they got the mortgage-backed securities and mortgages and all sorts of things. So back in the old days, they were invested in bonds. Now they practically invest in almost everything. Okay? And these are pension funds. Then I have insurance. It actually takes a very good expert in insurance to tell the exact difference. I don't know exactly why the textbook here says life insurance. As far as I'm concerned, they just have insurance. Of course, you got many types. You got over 15 different types of insurance. Casualty insurance and all sorts of other things. Life insurance is the key one. But insurance company is an insurance company. So you all lump them together. Of course, we can have a whole bunch of them. What is it they do? Again, it's the same story. They provide what's called insurance policy. An insurance policy is a financial instrument, not necessarily negotiable. In other words, you might not be able to sell your own insurance to somebody else, but it's a financial instrument. It represents a contract. A contract between the insurer, let's write it here in English, insurer, and the other one is called insured, also policyholder. Policyholder. Equals insured. So it's a contract between insurer and insured for the insurer to pay the insured in case of event. We call this insurable event. Insurable event is an event that can be easily recognized with unfavorable results. Insurable event is breaking your hand, breaking your leg, disease, sickness. In life insurance, death. Somebody dies, you pay to his wife the money, okay? Someone gets sick, you pay for the hospital. Someone gets sick, can't work, you pay or cover his income, okay? Another event will be car accidents. There's a car accident, you get a car insurance, okay? The car insurance can also include medical and health based on the car crash, okay? You can get separately motorcycle insurance. So when I was in the US, I had a nice big motorcycle, 800, and I had to have a separate motorcycle insurance. So they provide insurance, and they provide it for a price which is called premium. So we got two names. You can call it insurance premium or simply premium. And premium is the price or the compensation that the insured pays to the insurer for assuming the risk. So the insurer takes the risk. So the exchange, they trade risk for premium. That's it. Risk for premium. That's insurance. And insurance companies specialize in insurance policies. In other words, we say in covering risk. They are in the business of covering risk. Number 7, mutual funds. Mutual funds are a very special category of financial institution that specializes in money management. And they have a large number of characteristics. The first key characteristic, out of which everything else follows, is that mutual funds are public. Public. Public doesn't mean publicly traded, okay? Publicly traded means the security, financial instrument, trades on the exchange. Public means that it's open for anybody to invest in it. If you want, you invest in it. That's what public means. It is designed first and foremost to be highly regulated. The idea is that if Joe Blow the fireman is going to invest in there, the government wants to make sure that his money is invested safely. So they will provide very high standards, okay? They will have all sorts of regulations. They will be monitoring them. They will be requiring regular reporting. We call it also financial reporting. Financial reporting is known in the general category in finance known as transparency. Transparency means that management must tell its own investors, first and foremost, who the managers are. Are they crooks? Are they criminals? Are they like Bernie Madoff who took people's money and stole it all? Okay? Or are they honest people? Or do they have degrees in finance? Or do they have degrees in cooking? Okay? So, you want to know who the managers are. Second, you definitely want to know what their investment strategy is. Are they investing in stocks? Or in bonds? Or in currencies? Or in commodities? Are they investing in high-risk stocks or low-risk stocks? Are they investing in safe bonds or in junk bonds? Are they concentrated in oil companies or computer chip companies or in, I don't know, oil or in any other industry, car companies, or are they simply widely diversified? Okay, so they will tell you what their investment strategy is. The next required thing to tell you is their performance. Are they making money or not making money? How much money they made? In other words, when they say making money means in finance, return. They must report their 1-year return, 2-year return, 3-year return, 5-year return. If they've been alive and running for 10 years, their returns over the last 10 years. In other words, they should be telling you exactly what they did, okay? Otherwise, they go in jail. Another very important characteristic part of transparency is clarifying the fees which they charge. Mutual funds love screwing their customers. They want to take their money, and every time they take 5%, they say, oh no, we're very cheap or what, or they even don't explain to people how much they're paying. But over time, they've been discovered that mutual funds usually collect the worst kind of people as managers, and therefore, there is a strict requirement that they must report exactly what are the tuition and the charges that they must charge. Okay? So, that's what mutual funds do. You have a whole bunch of, again, it's a long and complicated story. Some people make even full university courses only on mutual funds. Others make full university courses only on investment banking. Okay, but that's the idea. Public, highly regulated, usually low risk. Certainly no leverage. No leverage. Leverage means risk, and one of the ways to lower risk is prohibiting leverage. Okay. Zach. Oh. Okay. No leverage. Okay, this on another important characteristic which relies mutual funds rely on is diversification. Mutual funds are large in size, from 50 million to a billion to 10 billion easily, or 50 billion. Some mutual funds could be 100 billion, that's not a problem. So they can buy 50, 100, easily 1,000 stocks. Some of them will just buy the whole stock market, 10,000 stocks, no big deal. Some will diversify across the world, buying shares from Taiwan and Korea and Singapore and Hong Kong and Japan. Now, since the last 5 or 10 years, you can even invest in China. And of course, they're going to be buying in Latin America, in Eastern Europe, Canada, Australia, and all sorts. So they're going to be doing an awful lot of diversification. And this is the biggest marketing tool to mutual funds is, oh, we diversify. And diversification is usually understood to mean low risk. Of course, that's not true. Just because it's diversified in no way means it's a low risk. On the contrary, if the stock market crashes and you're well diversified, this means you're screwed. Means if the stock market crashes 30%, you guaranteed yourself you lost 30%. So the more you diversified, when it crashes, the more you guarantee a loss. So suddenly it turns into a guaranteed loss. Okay, that's important to understand. You say, oh, you diversified, so you're safe. No, no, no. You are, let's clarify. Diversified means as safe as the market. If the market crashes, you crash with the market too. You're not safe, but you're safe as the market, okay? And if the market gets overall very risky, you are just as risky as the market. That's what it means. Nothing more, nothing less, okay? But diversification, importantly, is poorly understood even by finance students, and certainly common people have no idea what it means, have no idea how it works. It is presented as marketing in PR as safe and low risk, but it's clearly and certainly not safe. And we have one more piece which is important for mutual funds, and then we take a break. Economies of scale. Well, another one comes to mind. Economies of scale means that they can keep the costs lower as the size increases. For example, you can increase the size of a mutual fund 10 times, but the cost will not even double, because you can still run it with the same number of managers, you can still run it with the same number of accountants, with the same computer system. So as you expand mutual funds, costs don't rise much. You don't probably have to increase the cost of advertising. Maybe you just need to increase more sales or more customer service. But overall, economies of scale means that as the number of customers increases and as the size of the mutual fund increases, the cost per customer or the cost per invested dollar keeps falling. The best example of economies of scale that you can easily see here is increasing the number of students in this university. If this university has already 9,000 students, is it that difficult to increase them to 10? Well, maybe not. Maybe there's still housing available. Sure, for sure you got plenty of classrooms available. For sure you can get an extra professor. That's not easy. You don't need new administrators, meaning the accounting department can remain the same, executives can remain the same. Most of the cost will remain the same. So you can increase with 1,000 students the university at a relatively small cost, okay? Which means that the average cost. So economies of scale, the definition. Barry, paying attention? No, not paying attention. He's busy. Economies of scale means, yeah, average cost is falling as the quantity increases. So as the number of students increases, the average cost of tuition falls. As the number of clients in a mutual fund increases, the average cost of managing money per client falls. Okay, that's economies of scale. And the last key characteristic before we finish is professionalism, or professional money managers. Mutual funds take pride that they have highly trained, highly skilled, experienced, professional money managers. Now, this guy has been doing money management, running mutual funds for the last 20 years. He knows what he's doing. He understands everything. And basically they're saying is, do you want to give the knife to your wife to do your surgery? Or do you want to go to a surgeon who studied for 10 years and has been cutting people for another 10? And yes, of course, do you want to have your son, clean your teeth, or do you want to go to a dentist? Here, the advertising go, do you just want to give your money to your neighbor, or do you want to give it to a professional who's graduating from Harvard, Princeton, Yale, and who knows what he's doing? So this is a major marketing, but it's also a legal requirement. They have to have knowledge, skills, certifications, and so on. All right? Break. Finish.